All right, good afternoon. Hi, everyone, and welcome to today's session. I'm going to give it a few moments just so we can have everyone join in. And while we're waiting, it's always good to see where you're from and saying hello in the chat. So the chat is open if you're looking to say hi. Hello there. All right, so let's go ahead and get started. So within this series, we've been talking about income, and the first educational session that we did, we talked about covered calls and we talked about cash secured puts. Today, we're going to talk about consistent income, and we're going to focus specifically on credit spreads. Credit spreads are really an extension of cash secured puts and covered calls in a way, and we'll talk about that the way that I teach it. We like to really utilize those strategies as the strategy driver, and we'll talk about how we can utilize long options actually to mitigate the risk potential that's found with individual short options if you don't own the underlying security or have the cash set aside. And I did get a note in there that the sound is bad. Is there any issues with that? Let me know. I can switch things around. Got at least 7 microphones in front of me, so we can move things around. All good? Okay. All right, so education, I think it's important to talk about options education. So at Options Play, we really focus on education. That's primarily my job. Been in the industry for 15 years, but I tend to always gravitate towards education. And at Options Play, we want to empower you to trade sustainably and confidently. That's what we focus on. That's what our education is designed with. Really empower you and have that instill confidence in you, but it's also to grow your account sustainably in that responsible growth aspect as a trader. And like I was saying before, the first classes were mastering the #1 income strategy, which was focused on covered call writing. So we'd utilize that on your existing portfolio, can be used for the longer term. May 2nd, we talked about purchasing stocks with options, utilizing a discount, or those options acted as a discount from the premium. And now we're going to take it to the next level, utilizing spreads today, which is that consistent income in any type of market. When you have options, that's the beauty of it, is you can be profitable in a bullish, bearish, or neutral market. What we're talking about today isn't largely directional, but it's slightly directional. You will have a directional bias. So we'll talk about that and how to construct those strategies together. And naturally, before we get started, it's important to give you a disclaimer. Know that the types of securities forms and research tools, they're just for demonstration purposes only. I am going to pull up the Options Play Canada tool, probably go over Shopify and a couple of other things. I'm just pulling up securities, maybe even take some from the chat, and just know that's for an example and informational purposes and educational purposes only, not intended to be tax, legal, or investment planning advice. Of course, investing always involves risk. So let's talk about our agenda today. So first and foremost, we're going to talk about credit spreads. What are they? What are comprises the anatomy of a credit spread? What's the optimal environment? We're then move into bear call spreads, and then we'll talk about bull put spreads. So we'll go through again how to construct that, some best practices, inclusive of creating the trade, entry and exit points, as well as just purely understanding those foundation elements are extremely essential. Then we'll go into trading credit spreads. So again, looking at that broader optimal market and some best practices, have some good tools for you. We'll pull up the Options Play tool at that time to make sure that we go through outcomes, what happens when we're wrong, what happens when we're right, how do we define those optimal environments. In addition to the optimal environments, how do we construct the optimal trade? So that's going to be really, really important. And then, of course, best practices are going to tie into that and then save some time for Q&A at the end. But really, what we're focusing on is how can I maximize my income in any market outlook with credit vertical spreads? Lots of names for options. And I like to say that because options have so many names, you just need to know how they work regardless of the name. They tend to be called different things depending on where you trade. But today, credit spreads, vertical credit spreads, bear call spreads, put spreads. Those are all kind of the same thing there. And a long put spread and a bear put spread, those are directional trades. So that's different. The bull put spread is the credit trade, and then the bear put spread. But we'll go through that in detail. I've got examples of all of the above. So let's talk about credit spreads and what they are. First and foremost, they're an income generating strategy, which means that you do not, anytime it's really anything is income oriented, you don't expect a large directional move. Whenever you are buying options, you make the most money, or you intend to, because you own the rights to execute upon the terms of the contract, you want it to have as much value as possible, which means you need it to move in your direction as much as possible. So we're buying a call, we profit if it goes up, buying a put, we profit if it goes down. So that means that we need it to move more than what we paid for the contract. When we're on an income generating side, we didn't contract, we received it for the contract. So that's inclusive of an individual short put and an individual short call. You received a credit, and we're having a net credit altogether, which means we want the option to actually go down in value, which happens as long as it's not in the money at all. And in the money just means has executable value of at least 1 penny. So for example, if I have a call with the right to buy ABC stock at $100 per share, that has value as long as the terms of that contract are more favorable than the market. So if the market has ABC at 105 per share, my contract has the right to buy ABC at $100, immediately execute on the terms of that contract, sell, buy 100 shares of ABC at $100 per share, and then immediately sell it at the market for 105. That's where it has some value. And that it makes sense, right? If I have a purchasing options, I would like it to go up in value as much as possible. Now, that option has no value as long as the market is at least a penny more favorable. So in that same example, it would be if ABC was $99.99. That means that it's more favorable for me to go buy ABC on the market than to execute upon the terms of the contract. Hopefully that makes sense there, but that's why it's important to know on income generating strategies, you have a slight directional bias. You're actually neutral, and you may feel that the security will go slightly up or down, and that is it. Otherwise, you'll end up making more money in a larger directional move, which we'll talk about when we say those optimal environments. So that's what I want you to take away from credit spreads. Point number one on income generating is we're just looking for a security that isn't going to move too much. Lower beta means just doesn't lessen the market. So Tesla has a high beta because it moves quite a bit, whereas something that's more cyclical probably has less of a beta. So hopefully that makes sense. Put number one in the chat for me. So just, I am selling an option. I want my option to have as little value as possible, which means that it can be very, very slight, just range bound or slightly moving my directional favor. And we'll talk about that. Now, when we have a credit spread, lots of ones, thank you for that. We are creating defined risk. Again, when we are buying, I don't think I can. Let me see if I can enable closed captioning. I do not. I am sorry. That's something I'll take back to add. I had a question in there if we could enable closed captioning. I will take that feedback back, and maybe that's something we can add in the future. I think that would be super, super helpful. When we have a credit spread, we are also creating defined risk. And what do I mean by that? Well, when we have a short call, remember, I'm selling the right to buy an underlying security. And when I'm selling an option, that means I'm obligated to make that contract whole. It's a contract between a buyer and a seller. So if a buyer purchasing a call that contains the right to buy, I, as the seller, have to sell them the shares at that strike price, that agreed price, at their discretion, which means a short call has unlimited risk potential. And a way to mitigate that is by creating an offsetting position, which is what we do and why credit spreads involve two option legs. The purpose of the additional option leg is to create an offsetting right to that obligation, meaning the short call contains the obligation to sell the stock at the strike price. My offsetting right would be a predefined price to buy that at. So that way, if the security doesn't move astronomically adversely, which is well above the strike price, which means that contract will have value, which is not what I want on an income generating strategy. But I'm going to mitigate that risk by having a predefined purchase price. And then the opposite, the inverse is true with puts. That just means I have a predefined sell price if it moves adversely. And again, we've got some examples. We'll go into that in a lot more detail, but this is the preface that I want you to have in mind, and then we'll kind of get the muddy waters clearer as we go through this presentation. So a credit spread reduces substantial or unlimited loss potential that's found in individual short options. An individual short call has unlimited risk potential because the stock can go to increase to theoretically an unlimited price. And a short put has substantial loss potential because the stock can, of course, go to only zero. And the loss potential that we want to mitigate on either side. So by adding another option, we create defined risk with a limited reward. When we add a credit spread, we now have a higher probability of success when we have proper strategy selection, which we're going to talk about. So hopefully when we're going through the first one with income generation, you know that when you buy an option, we are expecting a large directional move. If you're expecting a large directional move in order to be profit, that tends to have a lower probability of success because of the way that you structure the options. Now, which is why we have different best practices, which is not in this session, but something that we'll do very, very soon. Now, if you take the other side, you have a higher probability of success because your underlying security either needs to stay exactly where it is or move slightly in the desired direction. Not a lot, just slightly, which means you have a higher probability of success because you don't require lots of movement. You're either already at the journey or you're just leaving a little area to go. And even if it continues to climb, you'll still be profitable. So that's why it has a higher probability of success, which is important. And that just simply is due to the lack of directional movement needed to be successful. That's all it means. I don't expect all of this to be 100% crystal clear. But what I do want you to do is think about these when we're thinking about credit spreads is, okay, I am in an income generating mode, which means I'm not largely directional. I expect things to be range bound or move in a specific way. I'm going to cap and risk potential, and then I have a higher probability of success. There's always trade-offs in every aspect when trading options. So moving on, let's talk about a short call. So a short call individually has an unlimited risk potential. And I always like to start with calls when explaining options because they're here to understand for some reason. But a short call individually is neutral to bearish, meaning in this example here, I have that we're selling to open one XYZ 110 call at $5 per share. So that means that this is established at a net credit. I'm receiving $500 total, and this is profitable as long as XYZ stays right at 110 or is at 109.99. That's it. So that's what I mean by the little directional movement to be profitable. What happens is our max gain is limited. If you haven't seen a profit and loss diagram, I like to use them because they're also a good visual representation if something has limited risk, limited gain potential, and if it's bullish or bearish or even neutral. So this flat line here tells me that there is a cap on my gain potential. No matter how low the security goes, the most I am going to make is that $5 premium. However, if the stock price was to increase in value more than the premium paid, so $5 right here, that's when I start having this unlimited loss potential. So I actually break even if 115 because I am obligated to sell the shares at 110 and I could buy them at the market 115. That is a $5 loss offset by the that needs to make it crystal clear. One XYZ moves and I'm wrong and moves beyond 115, then I'm going to start creating losses. So I'll repeat that one more time just to make sure that's crystal clear, and we'll do a quick knowledge check. So my max gain is limited to the premium received of $5. That is my safe area. So if XYZ moves $5 higher than my strike price, so this is 110, this $5 is my premium, so to 115, that means I break even because I'm going to be obligated to sell the shares at 110. I could buy the shares at the market at 115 at that point, but that $5 loss, since I'm and then selling at 110, is offset by the $5 premium that I receive. So that's how, even though probabilities are in my favor, if it moves up, then I could really have some poor loss potential if X continued to rally beyond 115. So that's important to know when we're talking about optimal environment and optimal construction. So when we have a short call on an individual basis, we would expect the stock to remain where it is, or nothing too far lower. Otherwise, a different strategy would actually make sense. For the trade, we're going to talk about at the money options here. Important to know with 45 days until expiration, because options are not priced with just the underlying security. They also include time and implied volatility, which is extremely important when we're talking about optimal environments. So we'll go a little deeper into that. Your reward, it's limited. The max that you will make on this option is $5 share or $500 total, regardless of how low equity falls, because this is a limited potential strategy. If you are expecting a larger directional movement, off buying, you need that put to overcome the premium that you received. Your risk, however, yes, fees and commissions naturally, and they're or inclusive if you're buying the put. The risk, of course, is unlimited potential, which is important to know. And this actually requires the highest level. Lots of brokers require you to also have a very large asset level because you could end up having margin calls. Your account could be negative. The short call is actually the most riskiest options trade that you can possibly do. And you can see why, because if it moves adversely, the max amount of your loss potential is completely unknown. That, well, you've created to sell at 110. In order to mitigate that, we just simply give ourselves the right to buy, but at a less favorable price. And that's where we talk about strategy driver. And in sessions, I tend to use that very, very often. So what that means, we have we sold to open one XYZ 110 call at $5. We're going to buy to open a out of the money or further out of the money call at 120. That's going to be at a less price, which makes perfect sense because the right to buy XYZ at 110 is much more valuable than the right to buy XYZ. Therefore, the right to buy at 120 should be less of a price. And these we're going to assume have the same expiration period, which is that 45 days until expiration. That reduces the amount of premium that I received. That's the trade-off we're talking about. But what I've done is I have hedged where losses can occur. Because if I'm wrong, it's going to happen at some point, and that's why it's very important to talk about strategy construction in optimal environments. But if you are wrong, now you're removing your unlimited loss potential. Now, the loss potential in this case would be the difference of the strikes less the premium that you received. So 650 here. I can still afford the amount that my break even will. So now if the stock, I'm going to be losing a little more quickly by the amount of premium that I paid. However, if it continues to move adversely, I'm not finding myself in a terrible situation. And I have now a defined loss or a limited risk potential, which is extremely important. So that's the way that I love to describe spreads is, and in any option strategy, there is a strategy driver. And the strategy driver for a bear call spread is the short call. The strategy driver is always the most expensive option. And the strategy driver means that this is the option that dictates the directional bias. In this case, is 10 call. So directional bias in this view is bearish because when I individually sell a short option, I do want the underlying security to either remain where it's at or move slightly lower. And if I'm wrong, I just am buying myself an offsetting right. So I've created the obligation to sell. My offset rate is the right to buy, and that's how you mitigate your risk potential. And then what happens is we have a credit, and then we have to talk about what credit is optimal for the risk that I'm taking on. But as far as the foundational elements that I need you to understand is what's driving this is the short call, and then the purpose of adding that long option is just to mitigate unlimited risk potential. And in exchange for mitigated risk potential, I'm accepting a slightly premium. If that makes sense, go ahead and type 2 for me in the chat, and then we shall move on. Lots of 2. Perfect. And in the previous example, I did see a question that, is this a naked call? The answer is yes. A call is, this is not a spread is not a naked short call, but a in short call. This is naked because it owns no offsetting position. So it's literally naked, not covered by something. And it can be covered by something which is either, since I've created the obligation to sell, either A, I own the stock, which is a completely different strategy. That's a bullish strategy because the strategy driver is the stock. Again, always the more expensive thing. And when I add the credit or the long option, and that is setting, which is the right, instead of owning something, it's the right to own something. So that's covers, this is considered a spread because we have something that covers short obligation. That's the difference of it. And it's whoever created those terms, literally naked means not covered by something, and you're exposed to risk. And that's important to know, and a good way to put this together. So let's talk about strategy selection for a call spread. First and foremost, and this really isn't right now due to lots of other reasons, but you profit from expensive premiums. Now we know an option is premium is comprised of many different things, including of the underlying security. But aside from the underlying security, what affects an option is implied volatility and time until expiration. Implied volatility is normally amplified with times of uncertainty, and that's when we have high market swings. Even though we're in a largely bear market, a lot of the uncertainty has been realized a little more. So volatility implied volatility of the options itself. You can also look at volatility from the market overall. There are a lot of metrics that we can utilize, and ideally all of them, to understand if an option premium is overpriced, and that's what it will tell us. So anytime that an option is overpriced, that's something that I want to take advantage of. But you also need to know your optimal environment. So I want to sell income when I know that it's overpriced and I come down. So I have volatility, but I expect volatility to come down. That uncertainty is going to wither away. So maybe around some sort, earnings is a risk in itself because that creates a large directional. It's a really good example. If you were to pull up an chain on your brokerage firm and pull up a security that is about to report earnings and have the column for implied volatility, and this is, I'm talking 2 to 3 days until earnings, or even same day. If you look at the volatility column on that option series meaning expiration date, where they're reporting earnings, you'll see really high implied volatility. Sometimes it's 200% or 120%, something really, really high. But then if you were to look at the next date, it'd be normal, maybe 30, 40%, whatever that is normal to find for that option security. That's a great example of how an option is overpriced due to high implied volatility. Implied volatility, the textbook definition is the market's likelihood of an anticipated, likelihood of an anticipated movement in the underlying security. So around earnings, we know that a underlying security or a stock is drastically based if it meets or misses analyst expectations or even forward guidance. But we know there's going to be a move. But as soon as that report hits, we have information that we need. That move's going to happen. Implied volatility contracts, and that's something called implied volatility crush. Now, we wouldn't want to create an income strategy around earnings because now we've created risk because of this directional move. So that's why it's important to know, implied volatility, but we don't want it due to something like earnings, because this view or our view is something that is or range bound, we neutral to slightly biased, not largely directional. So that's why it's important to know optimal environment in addition to your view. And that's how it creates a security that we know that this is a good trade to execute on. So we profit from expense premiums. In this case, when we're neutral to bearish, not largely direct. Our view in this is you expect a continued decline and you see a resistance to a rally. So in this case, this security went to this price here, did not come down, retracted, tested this same price here, retracted again. And know that when you're looking at charts, this is not an hourly chart, it's to be a daily chart. So we know that this is a longer time frame. Never look at an hourly chart as any type of indication of a term strategy. Your chart time frame will give you a different view. So we see a continued decline, but a very clear resistance to rally, which means, and then we also have our optimal environment created. So then our view, we want to make sure is in harmony view. So we will have a short call. So in this case, we'll have that short at the money. I see that I've got a couple notes that says my audio choppy. Let me turn off a few things. I think I have my charting program running, so let me turn that off for you. I sure do. Hopefully that helps. All right. Thank you for bearing with me through that. Okay. Hopefully that helped the audio a little bit. I'm sorry, I had a charting platform going in the background. So what we do here is I would be selling my at the money call, let's say perhaps here at $5 in order to mitigate my risk. To do it at this clear resistance point. I could even do it up here, just as long as these two things are harmony. This is a less valuable call, so I'm going to receive less of a premium that we talked about before, and I'm profitable as long as this security stays right at 110 or moves lower. See clear resistance here and here. If it's not surpassing this zone, as I see here, optimal environment, and then I might mitigate my risk here. Or I may want when I see consistent test here. Now let's look at a short put. And this is still choppy. Yes, okay. Only thing that works in this place is I'll turn off my video. And make sure I've got an Ethernet cable plugged in. All right, is that better? maybe. So far, great. Okay, let's talk about the short put then. So the short put is really just exactly the opposite. Whenever we are selling a put individually, we have substantial risk potential. Now, if you attended the last session, we accepted and utilized the obligation that was found within the short put to purchase the stock. However, that requires a lot of cash in order to buy that security. But we know that because that's ultimately our intent, is to buy the security. However, with a credit spread, it's either A, we want to have less margin requirements, or B, we do not intend on buying the security. So we have a slightly different view. We're neutral to bullish in this case. Our maximum profit is still limited to the premium that's received, and we are establishing a net credit. Now remember, the put contains an obligation to buy the security. And a good trick or rule of thumb when describing options that I like to put in your mind, that I always keep in mind, is whenever we say selling or shorting an option or short, we say sell. Whenever we say put, it's the right to sell. Whenever we say call, it's the right to buy. So if I'm long, I'm purchasing. If I'm short, I'm selling. Call, the right to buy. Put, the right to sell. So in this case, I'm short a put, so I'm selling the right to sell. And since I'm selling the right to sell, I'm obligated to make that contract whole. And the way to make that contract whole is by buying the shares. So I'm obligated to purchase the shares in this case. I'm only obligated to purchase those shares, though, if the long option holder execute upon the terms of that contract. So always look at your likelihood of assignment or having to fulfill your obligation through the long option holder's eyes. Another analogy I love to use is driving a car. If you are buying an option, you are the driver. If you're selling an option, you're in the passenger seat. You could take a look at your surroundings, understand if the driver is going to stop, go left or right. Maybe they turn their blinker on, who knows? However, you have an indication of where they're going to go, or at least an idea, because you're paying attention to your surroundings. If you're looking down, you're not necessarily. So pay attention to your surroundings, and you will have an idea if the buyer is going to execute upon the terms of that contract. You won't always know, but you will at least have an idea. But you're obligated, no matter what that driver does, to go left or right. You're in that car. So if I sell to open one XYZ 100 put, that means that I'm obligated to buy 100 shares of XYZ at $100 per share at any time at the purchaser's discretion, or a purchaser's discretion. In exchange for that obligation, I receive a premium of $5. They are the ones that are giving me that premium of $5. I do not want them to execute upon the terms of that contract. In fact, I want that contract to go in value as much as possible. And that occurs when it doesn't have any value, which means that the security moves up in price. So if the security moves up in price, the contract begins to lose value because this contains the right to sell at $100. So if the market's at 101 penny or 101, no matter how high it goes, the market's going to be better than this contract, which is how I will receive my $5 per share or net credit. Now, the opposite is true, like with the short call. My buffer area is that premium that I received. So if the underlying were to move adversely, then $5 is my buffer room. So if it were to move to 95, well, now my put's beginning to have value, because selling at the market price of 95 is less advantageous than less advantageous than the strike price of $100. So that $100 strike price is much more valuable. And as the security continues to decline, then my put becomes more valuable, which means I would have to buy it back at a lower price. So, but if I felt like the security was going to go down or move down, then I would have been better off having a different strategy. Or if I felt like it was going to move higher, different strategy. This is not directional. This is just, I expect the security to be range bound or move slightly higher, but I expect it to be exactly where it is. It has implied volatility. I expect that volatility to move down, and I just want XYZ to be at 100 or slightly higher. So sideways or slightly higher. Again, that's an at the money put that I described. At the money means that I'm selling a put at the same strike price as the market price, and then 45 days until expiration is that specified time frame. Now we say 45 days until expiration because, again, options are priced by three main components, which is the underlying stock value versus the strike price. We call that intrinsic value or in the money value, executable value, lots of names for it, and then time value and implied volatility. That 45 days until expiration goes into the time value component. The farther or the longer we have until expiration, the more expensive the option is going to be. But guess what? We don't go that way in time. Time is always moving against us. So as someone who's selling an option, we want to capitalize on that. It's also called that we're positive theta, positive time value, because the time decay actually works for us. And that's because as time moves and then we get closer and closer to that expiration date, makes the option less valuable, which means that we can buy it back at a lower price, which is what we do. We want to do. We want to sell high, buy low. Sounds good in theory, harder in practice. Our reward is limited to the premium that we received, no matter how high the security goes. And our risk is actually substantial because we're obligated to buy this security, and that obligation kicks in normally when this starts losing all extrinsic value and the underlying security moves below that strike price at expiration. So in order to mitigate that risk potential, we have to create an offsetting position. So since the obligatory position in this case is we're obligated to buy 100 XYZ shares at $100 per share, our offsetting position would be a rate to sell. So that's how we would create the bull put spread. Is we still have our strategy driver, which is the XYZ 100 put. It's more valuable to sell at 100 than 90. Therefore, this will absolutely be more expensive. We're going to buy an option that's further out of the money or less valuable, which means it's going to be at a cheaper price. That reduces the amount of credit that we received. But in exchange for reducing the amount of credit that we received, we've now limited our risk potential and reduced our risk potential from substantial now to limited. And it's now the difference between our strike prices less the premium that's received. And that's the purpose of creating credit spreads. Credit spreads are risk. The intent of adding that long option is purely to mitigate risk. So hopefully that made sense. I would like to start with calls because I think it at least makes more sense in my mind. And then puts really are just the opposite. So again, this is the same type of scenario. We're looking for a high income and high implied volatility. If an option is more expensive, then that means that's an optimal time to sell. So therefore, we want to start generating some income at that point. Or if we're choosing then a call in or put, now that we know we have our optimal strategy, just am I slightly directional bullish? Am I slightly directional bearish? For the case of a short put, it would be bullish. And I'm looking for that consistent rally and some defined support. So in this case, if this security were to perhaps move above here, and I see that old resistance now becomes new support, I would expect this to remain above. So it hasn't done that yet, but if it were, then I would sell that at the money 100 put at $5 per share and then mitigate my loss potential by having that offsetting position. So that long option at 90 at the less price. And again, this is if the security was here, I would not enter that here. It does not make sense. That would be more of a bull call spread scenario because again, largely directional, this is not. Therefore, this would be profitable as long as the security remains above 100. So stays the same or moves slightly higher. And that's how we would create that bull credit put spread, credit vertical put spread, lots of names again for that security. But all you need to know is what's the strategy driver, what's the optimal environment, and how do I construct that strategy? So hopefully that made sense for you there. If that was clear, go ahead and type a 3 in the chat for me. Great. Let's talk about trading credit spreads and the optimal setup. And we talked about that briefly before. I've got an example here just on the bull put spread because that's where we left off. But know that this top part is applicable to all. This bottom, the example is the bull put spread. So first and foremost, you are neutral in a security. You see it stuck in a trading range even, but you have a slight directional bias at one end of that trading range. You have, it's very important, an option level that allows spreads. This does normally require a higher options level because margin is required normally for spreads. Your trade, we sell in at the money put if we're bullish, or sell in at the money call if you're bearish, and you add your defined risk point with an offsetting position. So that's our what and when. And here's an example of our put. We would sell 145 days until expiration. And remember, or that there's always a typo there. Pretend this is 100. 45 days until expiration, we talked about that time component. We see high implied volatility. We feel like that's going to contract. So this is our what and when. Our setup and tips. We're going to do an expiration for 45 days until expiration. And again, we talked about that briefly. That's allowing proper theta decay, because something happens around 40 to 21 days until expiration is your time value starts to rapidly deplete. It's not something that's linear. And the closer you get to expiration, it kind of falls off of a cliff. And you can see that visually representing in the options play tool, which I'll pull up in one moment, or even on an option chain. You can just see the extrinsic value, or you can add a column called theta and see how it moves with your option and how it is just gone. And that's because an option is only worth its executable value on the day of expiration. So any excess time value is going to be depleted because time's up. There's no more time left. So what we need to make sure if we're on the sell side of options is that we give ourselves enough time to capitalize on that theta decay. Our strike prices, we're going to sell an at the money option, the 0.5 delta. So that an at the money option, again, is an option that is at or near the same strike price as the market. 0.5 delta means that you have a 50% probability of the option being in the money or not. And that makes perfect sense, because if the stock price is at 100 and your strike price is at 100, it moves 1 penny or 50, it moves 1 penny up or down, you have a 50% chance of it being in the money or not. That's literally where it comes from. If you buy a out of the money option, so our options plays best practices is about a 0.25 delta to offset that risk potential. But the expert tip is looking at IV percentile. We talked about implied volatility and how it's higher around earnings as an example, but options implied volatility is not all the same. So that's where IV percentile is really, really helpful, something we're working on adding to the Options Play Canada platform. But what it tells us is, like Tesla, for example, it always has high implied volatility because it always moves a lot. A high beta stock tends to have a high implied volatility. So if we have an IV percentile greater than 50, 50 is its normal area, and this is measured from a scale from 0 to 100, then that means that it's higher than it normally is. Otherwise, if you're saying, oh, this has an implied volatility, that might just be the way it is all the time. So I want to know, is it higher for itself? Is this a more volatile person or security? And is it more volatile than it usually is? Why is it that way? It's not earnings. Great. That's a good environment to start selling some premium. Additionally, this is very, very important, is we want to make sure that we collect at least 33% of the vertical width. What does that mean? The width of these two, so it's the difference here. The width of this is $10. So I want to make sure that I collect at least $3.33. I need to make sure that I have about 3-to-1 risk to reward ratio. And the reason why I want that 3-to-1 is because the probabilities are higher in your favor, meaning I'm risking the 3 making the 1. And then closing out, we look at taking profit around 75% of your premium. So that's about $3 in this case. Take a loss at 100% of premium, and consider rolling about 14 to 21 days until expiration, depending on how that options moves. And that's because that's when theta decay has started occurring. So when taking profit, that means that it's moved in our favor. So in the short put example, moved above our 100 strike price. Take loss, that means it's moved below our strike price, so adversely in this case. And then this is the time component, which is an important component of an option. And this here, love to explain this, just a different view of the same charts that we've been seeing before. And it's, I think, really gives a good idea of optimal environments and your views in how these types of strategies work. So for the short put, in this example here, the credit that we're receiving is $4 and we've got a $10 width. That means that my max profit is limited to that $4 premium. But if the underlying security were to rally well above 104, that's what we call upside risk, but that's as far as I want it to go. If it was to go any higher, I should probably done a different strategy. I still would have made out well and done really good. And I depends on implied volatility as well. And that's why structure is really, really important, and to know your optimal environments. But from a purely stock movement perspective, that's important to know. Oh, my mouse is very sensitive, apologize. From the downside, that same $4 is the amount that the stock can move, again, from that strategy driver, which is that 100 put, before I start losing money. And that's why we also talk about the having 33% of the vertical width as well. It's important to know we intend to do these trade small and trade often is the saying. That one's from Tasty Trade, but it's important and carries over some great best practices there. We all learned quite a bit from Mr. Tom Sosnoff. But we have our best practices. It's not only on the portfolio level. So about 2% of your portfolio is what you want to risk for one trade. So that we're knowing our risk here. We collect 33% of the premium. Then that means if we're wrong, we're more likely to overcome it. So that's the importance of that best practice that we're applying. And then I also see a question here. What happens if the stock remains between the at the money and out of the money option? Well, that's what we call broken spread assignment. And normally what happens is, first of all, we never want to hold an option till expiration, because when it starts moving adversely and is in between our strike prices. So in this example, perhaps it's at, let's say 92. You're going to have different prices on these options depending on if we're at expiration or we are still have some time left into those options, because there should be some type of time value there. Therefore, that's why we never hold an option till expiration, because now you've got a really large issue on your hands. If this is around 92, well, this 90 put, that's not going to be worth anything because at expiration, because selling at the market price of 92 is much more valuable than selling at 90. And again, we own this long option, so it's up to you to decide if you're going to exercise it or not. The short option, on the other hand, you have an obligation, and that obligation is absolutely going to kick in. And sometimes this gets so deep in the money and it has no extrinsic value that that obligation may kick in even early. That's why this is here. Therefore, you would buy at 100. You'd end up owning 100 shares of this security in your account at $100 per share. You still keep that premium overall. Say you didn't do anything at expiration and your account could support it, or something happened and your firm didn't close you out on the day of expiration and it was at 92. Well, assuming all stays the same, then your loss is offset as almost exactly the same price as if you were to close it on the market or trade it on the market. Meaning you bought at 100 and then you could sell those same shares at 92. That would be an $8 loss. And I would expect this to be pricing at exactly the same. So it's so much better to trade your options prior, because then you run into those issues where your obligations kick in. And it's also important to know from the OCC perspective, Those obligations actually happen. The exercise cutoff time is 5:30 Eastern time, which means that that obligation can kick in all the way up until 5:30. So it's an hour and a half after the stock stops trading. So a lot can happen on the day of expiration. That's why it equates to risk when you are holding an option until expiration in so many ways. On the short option side, it means you now have risk of the stock moving adversely because you probably lost all your time value. So if you are in your max profit, you might as well just take it at that point. If you have a long option, you've lost all your time value, and that's something that you want to sell to close in order to be profitable. So it's always never a good idea to hold an option until expiration because a lot can happen. And normally your brokerage firm will close out your options if you cannot support it on your behalf. And they do that to mitigate risk, because if you end up buying, you'd have a large margin call. And then what if that stock moves adversely over the weekend because the debt ceiling wasn't resolved, or who knows? That equates to risk, and it's your firm's fiduciary responsibility to ensure that they mitigate that risk. So they do have the right, and they will exercise that right to close those options on your behalf. Great question. All right, so that takes us to 452. So talked a lot there. I did intend on bringing up the options play tool, which I'm happy to do. But if you do have any questions, please feel free to write those in the chat. As long as you registered for this event and are an options play member, we'll absolutely send out these slides afterwards. I do see that question there. But if there are any other questions, please feel free to put them in the Q&A or, excuse me, the webinar chat window. And especially if you need me to go back to other slides because the connection was a little choppy. While you're doing that, I will go ahead and bring up the options play tool and give you some outcomes and talk through those optimal setups one more time. All right. Pull up Shopify. Just been looking at Shopify. Unless there are any other securities anyone is wanting to look at. So in the options play tool, I'd pull this up as income, or sorry, high implied volatility. And by default, we'll fill in those best practices. So you notice when I go into modify, I should have something close to the optimal time frame. So a 73 or 38. So that's as close to 45 as we could possibly get. And then it starts filling out the necessary best practices that we just talked about. So that's the beauty of the options play tool, is automating that aspect for you. The options play score looks at your risk versus reward and gives you a score, actually goes higher than 100, but it's going to turn green if it's higher than 100. So that's what we're looking for here. But what's great about this tool is not only are you comparing a straddle versus a fair call spread and that bull put spread, is I could actually modify this and look at different types of scenarios. So we've got the June 16th, 84.78. Perhaps we want to move that around and see what happens with a different strike price. We could do that here. And that's honestly what I use this tool for quite a bit. So let's do a short put vertical. And I want to look at maybe the same one. Let's sell the 86. So that's the 0.5 delta, or the closest we can get to a 0.5 delta. I'll still keep the 278, which is 0.25. But I want to see what happens in different time frames. We can adjust that here. You can see perhaps the premium changes, perhaps it does not. That's a good way to just look at my risk versus reward and understand what happens in different scenarios. And then I can add the P&L simulator just to see how I feel. So if it's going to go high, how much do I make? What happens at expiration? What happens if implied volatility increases? What happens if it decreases? That's where this tool is really, really helpful, is on these different scenarios, what happens in different types of strategies. And it's a really good learning tool from that aspect. And I do see a question on, can we hold a webinar to discuss straddles and strangles? Would love to. We have some of those ready to go, so I'll make sure that we do that very soon. So Peter, you've got a question that's more tax related. And I will say, I know the American tax rules for options off the top of my head. I do not for the Canadian. So I don't want to say that I know that. So if it's related to the US rules, I could definitely answer those. I imagine they might be largely the same, but I don't have that full confidence to give you that answer. I know with the US rules, you can go into IRS Publication 550 and read those. I imagine there's something very similar in the Canadian rules. I know anytime I pull them up, they tend to be a lot simpler and easier to understand. So I imagine there is something in there. But there we are. And are credit spreads included in trade ideas? So the trade ideas here, these are your underlying securities that are going to be your watch list and your ideas to pay attention to. So the way that options play set up is these are securities that are perhaps I want to choose my optimal environment. We can pull those from trade ideas. Otherwise, we've got screeners that have optimal credit spreads. So they've already scanned for super high implied volatility that are optimal for this type of environment, that have the optimal width, are a little more expensive than normal, and follow those best practices. That's an automated tool. So we do have a trade idea, but it's not in this exact widget here. And that's something I know that we're working on the Canadian version. So I don't want to necessarily pull that up right away. All right, I think that's all of the questions. And we hit about 5 o'clock. So again, I want to thank you guys for attending today's session. If you have any feedback on sessions that you want to see in the future, please feel free to let us know. Our job here at Options Play, especially from the education perspective, is, like I said, we want to help you build that confidence. So if there is anything that you are looking for or want to know more about, please let us know. That's what we're here for. Happy to do these sessions. We give them to our Options Play subscribers, free trial users, just anybody who wants to attend them, because education is that important. So thank you for taking the time to invest in your education. If you need anything else from us, please let us know, but I hope you enjoy the rest of your week, and we shall see you soon. Thank you, everyone.